All right, so let's talk about Chapter 9. In Chapter 9, we're going to talk about the conversion process, really. So the last chapter, we talked about that expenditure process. Now we're going to talk about the conversion process. And we're really going to be moving more towards a manufacturing perspective for the conversion process. So if we recall, the conversion process really is taking those raw materials, so wood for a table, glue for a table, screws for a table, that kind of thing, and we're turning it into a good that is available for sale. As we do that, it's going to follow through several different accounts, and we'll get to that here shortly. But recall that the conversion process does consist of the following steps. You have to schedule production, right? This is always important. You have to know this is part of your project management, right? When are we going to start producing these things? Then you're going to order your direct materials. This is an internal transfer. This is your requisitions officer. You go to them and you say, hey, we need a gallon of glue in order to complete this order of tables. And you requisition that glue from an internal source. And then we're going to use labor and other manufacturing resources to convert those direct materials to finished goods. So what you can see is it starts at raw materials, then it becomes a direct material when we transfer it, and then it finally becomes a finished good once we've completely constructed the good, and then it sits in a warehouse until it is ready for sale. Okay, so typically what's going to happen with these manufacturers is you're going to maintain 3 different inventory accounts in the general ledger. Okay, these are what we call control accounts. If you recall from some earlier lectures when we talked about control accounts, it was things like accounts receivable, right? That was a control account. There are other subsidiary ledgers within that account, but the control account is the main one. So these main control accounts that we're going to use for inventory are going to be direct or raw materials. These are the costs incurred to purchase and receive those direct materials. The work in process inventory. These are the costs of the products that we've started but we have not completed yet. So these are like the tables that, the top is finished but we haven't put the legs on the table yet. We can't sell them yet. And then finally you have finished goods. These are the completed tables that you can sell but you've not sold them just yet. So finished goods are available to sell but we haven't sold them. Okay. As I mentioned earlier, these 3 accounts, they're considered to be control accounts. Okay, the individual account details, we would record those in the subsidiary ledger. Okay, this graphic down here at the bottom, it's going to kind of show you how are we going to calculate our ending balances in each of these accounts, and then you can kind of see the cost flow, the way materials flow from one to the next. So you can see here that any direct material requisitions are removed from raw materials and moved into your work in process account, and then those total up to your cost of goods manufactured, and those move into your finished goods, and then your finished goods finally become your cost of goods sold, right? So with retailers, we just started here, cost of goods sold. As a manufacturer, we're starting all the way back at the raw materials section. Okay, so this would be an example of your general ledger for direct materials inventory. Okay, you have your GL or your control account up here, and then you've got each of your sub-ledgers. You'll notice that your sub-ledger ending balances, once they're totaled, they equal the ending balance of your control. Okay, you can follow the flow here. We used $80,000 in materials. 50,000 were plastic cases, 25,000 were components, and 5,000 were processors. Those add up to the 80,000. So these will all balance out to your control account. So if we're going to use a perpetual inventory system, which we're going to assume use of a perpetual inventory system throughout Chapter 9, then we know that we're going to impact those accounts directly. We are going to either increase or decrease those accounts directly. If you need more review, go back to the previous chapter, Chapter 8, where we talked about perpetual versus periodic, and we know that in perpetual we have a direct impact on the inventory asset itself. So let's say, for example, and these examples I've used directly from the book, so you can go through and you can follow along in the book if you'd like as well. So let's say, for example, that Apple purchases $102,000 worth of direct materials. We're not going to break those out just yet. We're just going to say, hey, these were direct materials, $102,000 of it. Since we're using a perpetual inventory system, we're going to directly increase that direct materials inventory account by $102,500. It told us we purchased them on account, so we know we've got to increase our accounts payable account. Okay? If you have any questions about the debit credit portion of this, please let me know and we can walk through that again. So let's take a look at the raw materials activity here. Okay, let's recall the following things about raw materials. The direct materials are physically traceable and expensive or material enough to warrant tracing. Okay. Then you have these things called indirect materials. They either cannot be traced or they are not expensive or material enough to warrant tracing back to the good. Okay. Direct materials we transfer directly to our work in process or WIP inventory as they are requisitioned. Indirect materials get assigned to this manufacturing overhead temporary account when we requisition them. Okay, so direct materials go straight to the work in process. Indirect materials go to the manufacturing overhead, and we will allocate portions of that manufacturing overhead to the work in process, to that WIP account. So let's look at an example real quick. Let's say that Apple treats components and processors as direct materials. Glue is an indirect material. It's not worth measuring. It's not worth tracing directly to it. Okay, so an entry to transfer $150,000 of components, $25,000 worth of processors, and $5,000 worth of glue into the work in process is as follows. So we have the WIP account, $150,000 plus $25,000. It's $175,000 total. We're going to put $5,000 of manufacturing overhead into this temporary manufacturing overhead account. Okay. Direct materials inventory, $175,000. Manufacturing supplies, $5,000. Right. We are decreasing both of these inventory accounts. These are the step 1 raw materials inventory accounts. Right. These are step 2 work in process inventory accounts. Then you got step 3, which is your finished goods inventory accounts. So we're increasing our new account, decreasing the old one. We are following them through. Okay, so this is just the flow. They're flowing from one account to the next. The next thing we have is labor. Very similar to what we talked about with materials. So you've got direct labor. That's going to be the cost of material, the cost of the employees that actually worked on the product, the guys that are standing on the line putting the product together. Then you've got indirect labor. These are costs of employees that support the manufacturing operations. So this is like your environmental services employee. He is cleaning up, he is organizing, but he's not directly manufacturing the product. So his labor would be considered indirect. Okay. We consider manufacturing salaries to be a value add to the product. We record them as an asset. Okay. Unlike non-manufacturing salaries or those indirect labors, which are recorded normally in a payable. Okay, so if you think about the admins that are sitting at the desk, they go straight to your selling and general administrative expenses. They do not go to the manufacturing salaries. They're not adding a value to the manufacturing process. And that's what we're trying to do here with this direct and indirect labor, is we are saying these types of items add value directly to our product. So we're going to include them in the cost, okay? And we're going to include them in the asset. So, for example, let's say Apple employees submit time cards at the end of January. There were 6,000 hours worked in direct manufacturing at $12 an hour, and there were also $3,000 for salaries associated with indirect activities. Now, these both, right, both of these add value, okay? They're both going to add value to the product, so we're going to increase our asset. So we're going to increase the work in process inventory, and we're going to increase the manufacturing overhead inventory. Again, manufacturing overhead is where all of our indirect costs, whether those are material or labor, this is where they're going to end up. And then we've got our wages payable, right? So instead of these being an expense right now, they're not going to be an expense until they come out in cost of goods sold, if that makes sense. Hopefully, as we go through some more examples, that'll make more sense. So we'll end the video here. If you have any questions or comments, please contact me. I am happy to hear from you guys.